Thank you, Gwen, and good morning, everybody. Well, I do like the shift to value investing. It's a perfect segue for Morien. Defines my own PA, and it defines Morien, frankly, hence the title, More Business Than Mining. You know, we're a very unorthodox company in terms of how we allocate our cash. I know this might sound like a bit of a buzzword, but it's shareholder focused. And as you're about to see, we have a consistent track record to support that claim. So at a high level, what this slide shows you, other than our ticker symbol being MOX, is that we have a tight shareholder structure, which is 50 million shares outstanding and very high insider ownership at 28%. Obviously, two important focal points for any public company. We have a 30 million market cap, we have no warrants, we have no debt, and we have a sustainable working cap position of 1.5 million. And I say sustainable because we haven't financed this company in 8 years. So before digging into the royalties, I just want to touch on 3 quick charts to give you a sense of our company and who we are. Management and directors are frequently buying in. We have 16% of the company. That's up from 15% just 2 months ago and up from 5% in 2015. We've been capital surgeons, frankly, when it comes to our balance sheet. We've been chiseling away at it for years. We show these charts every year, by the way. These aren't one-off events. They're down 40% from 2015. So as our revenues go up, our overheads consistently stay low. And on the right-hand side, something I've noticed, it's not discriminatory to the mining sector, but it does happen. Resources go up, production goes up, revenues go up, market caps go up, but so too do the total number of shares outstanding. And in a lot of cases, the share price just doesn't follow. Sometimes it could be construed it's not a very shareholder-focused approach. Whereas with Morien, we don't have that problem. Our share count's down 17%, and it's not because of some rollback. We've had a disciplined capital allocation strategy that has let me get approval from the board to spend $5.1 million to reduce our share count. We have retired 17% of this company, so we've enriched your ownership and not diluted it. Our 2 royalties are located in my home province of Nova Scotia. The Duncan steel-making coal mine is producing, it's paying us royalties. We'll touch on that later today. The Black Point project is owned by Vulcan Materials. They are North America's largest crushed stone producer. They have a 25 billion market cap. They're listed on the NASDAQ. This project's permitted. We're awaiting a development decision. And in the meantime, they pay us a tidy sum of $135,000 a year in advanced payments, pre-production payments, which might seem small, but actually, as you saw on the last slide, covers nearly a quarter of our overheads. And although I don't talk about it here, we are trying to grow the asset base. We're focused on the bulk commodity North American segment where no other royalty is focused. We've identified attractive opportunities to grow the asset base, but we are employing what has been described to me as a rather crocodile-like temperament in terms of how we make acquisitions. We're patient, we're prepared, we're waiting for the right opportunity. We had this level of strategic patience when it came to Duncan and Black Point. Clearly it paid off, and we're exhibiting the same level of strategic patience when it comes to making a next acquisition, which will be meaningful. The Duncan mine is owned by the Klein Group. They're a private U.S. company, one of the best coal operators in the business. They've spent over $300 million developing this steel-making coal mine in Cape Breton, Nova Scotia. It supports a large, massive 500 million ton resource that produces a 25-year mine life on the reserve. It's an underground mine, produces a steel-making coal, and we have a 2 to 4% royalty. Even 1.5% would be large for a mine of this size, but we get 2% on 500,000 tons every quarter, and everything over 500,000 tons, we get 4%. It's a meaningful employer in this part of Cape Breton, which has relatively high unemployment, and remarkably, it sits just 30 kilometers from a deep water port. The reason why that's remarkable is because the average distance from mine mouth to port for coal mines around the world is 300 kilometers. The Klein Group did idle Duncan during COVID in late March of 2020, and then in Q2 of last year, they submitted plans to the Nova Scotia government to bring the mine back online. Those mine plans were approved by the Nova Scotia government 2 months later. They staffed up, they're ramping up production. Commercial sales have commenced, and they're ramping up production, and our royalty is now cash flowing once again. If you're not familiar with the Klein Group, they previously operated 4 of the top 10 most productive underground coal mines in the United States. And I think that bears repeating, because even having 1 in this list would be impressive. They had 4 of the top 10 most productive mines in the US, and it was not a one-off event. The year prior, they had 3 of the top 10. That same year, they sold that company for $1.5 billion to Murray Energy. They came to Canada and bought 2 coal deposits, one in Alberta, which is now doing 10 million tons a year, and Duncan, which they're ramping up. So the same lieutenants that were in charge of the Klein Group when they produced this chart are in charge at Duncan today. There's millions of dollars being spent within the port, 30 kilometers away in Sydney, Nova Scotia. The Canadian Coast Guard is in the process of wrapping up a $4.5 million upgrade program to the navigational system. It's specifically the lights within the harbor. When that's done in November, we'll be able to bring in Cape-size vessels. We're looking at a Panamax vessel right here. This is a 60,000 dry weight ton vessel, and when I'm at the podium this time next year, it'll be a Cape-size vessel. That only benefits the economics of Duncan's export business. The port itself is owned by Ernie Thrasher. He was formerly on the board of Barrick. He owns X-Coal. It's a private U.S. marketing and logistics company that happens to own the title of being the U.S.'s largest exporter of steel coal. So lots of infrastructure here within the harbor to support Duncan. If you're not familiar with this subset of coal, steel-making coal is an essential ingredient in the manufacturing of steel. We all know we need steel, but one thing we may not know is that for every 1 ton of steel that's produced, you need 0.8 tons of steel-making coal. And for that reason, steel-making coal is often left out of the political discourse when it comes to decarbonization. In 2022, the world consumed 8 billion tons of coal. 1 billion of that was steel-making coal, and 328 million tons of that 1 billion was traded on the seaborne market. That was up 9% from the year prior. So this commodity is in demand. Gwen touched on ESG constraints. The ESG, environmental social governance constraints that are being placed on mining are particularly prevalent with coal mining. And although it doesn't happen at the political level, at the banking level, steel-making coal a lot of the times gets conflated and grouped in with its cousin, thermal coal. And for that reason, supply, the rate of new supply coming online is reducing, despite demand going up. Now, from my perspective and Klein's perspective, and perhaps yours, that fundamental supply-demand imbalance is very attractive. It's what's supporting coal demand long-term, steel-making coal demand. It's why Duncan's back online. And if you were to go online and try to find a steel-making coal forecast chart, you would not be able to find one that doesn't have the world entering into a near-term and sizable supply deficit like what we can see here shown from McCloskey in a recent chart. Switching gears for a moment, I think we can all agree that the single most accepted metric for looking at a company's performance is share price. And here we're looking at the share price performance of the 24 publicly traded North America-based mining royalty companies from February of last year till February 15th of this year. And this would include companies with a 10 million market cap all the way up to Franco-Nevada. And what you can see is the performance was broadly in line with the equity markets last year of -50 to +40. It's certainly not a performance that's discriminatory to mining or royalty companies, but the point of showing you this is that Morien outperformed its peer group by 6-fold. Now, clearly this was driven by news of the Duncan mine, but the point of showing you this is that when you have a tightly held stock with very few shares outstanding, you get big jumps in share price. We saw this happen with our friends at EMX Royalty in 2020 when they made that big announcement. It also does beg the question, where do we go from here? Well, clearly Duncan is just in the process of ramping up, and there's a lot of value to be had for Morien, but how much, and how do I quantify that? Well, at the risk of being flippant or facetious, I'm not going to fill you with some hope using the buzzwords that you frequently see in the mining space. We have the luxury of not needing to raise money, and we don't need to use this language. And so I thought I'd take a slightly more analytical approach today. We spend a lot of time trying to figure out the fair market value of our company because we have an active normal course issuer bid. We need to know this. And if you're familiar with valuations, what is typically required is the user has to make some judgment call on a key variable like discount rate or commodity price to arrive at the fair market value of the company. That works, but we do it a different way. We do it in reverse. At today's share price of 60 cents, which is where we are today, what is the market telling us about the value of our company, and do we agree with it? So we'll look at 4 examples. What's the discount rate that the market is placing on future Duncan cash flows? at a 60-cent share price? Well, the answer is 30%. The industry norm is 8 to 12%. Next, if you take a 10% discount rate and put that on Duncan's future cash flows, and you're conservative with the ramp-up schedule and say Duncan doesn't hit full production until 2026, what's the discount the market's putting on coal prices? Well, it turns out the answer is $85 a ton. The reality, coal prices are closer to $300 a ton. Now, we're a dividend-paying company, and I'm going to talk about that in a minute, and our dividend's poised to grow significantly. At a 60-cent share price, and looking at a multi-stage dividend discount model, it tells me that the market is putting a ceiling, it's capping our dividend at 6 cents in perpetuity for the life of that 25-year mine, when our internal forecasts tell us that the dividend will be materially higher than that. And at a 60-cent share price, the market is suggesting a 35% probability that Duncan advances to full production. When the reality is the mine's already producing, commercial sales have commenced. We have an experienced operator that's spent over $300 million bringing this mine online and selling a commodity that's in high demand. And so needless to say, we have a deep analytically based conviction that Morien's trading at a large discount to its inherent value. At full production, Morien will be bringing in between $7 and $30 million a year in royalties. I'm using the bottom end of $100 a ton because just before COVID and shortly after COVID, that's where it was trading. But if you look at the pricing that we had last year, the pricing we have this year, and the forecasts, our royalty would be generating between 15 and 30 million a year. That's meaningful for a company with a 30 million market cap. Even the pure play royalty companies trade at a significant multiple to their annual cash flow. So we reinstated our quarterly dividend program in November, and we did that 3 months before we actually got the first royalty check, just to give you a sense of how eager we were to reward shareholders and return cash back to our investor group. And we didn't reinstate the dividend program just to get on dividend radar screens. We did it to be at the top of that screen in terms of yield. We're so committed to the dividend model at this company that we actually built in a dividend calculator into our website, and I'd urge you to check it out. You can toggle coal production or payout ratio, which we've stated will be high, production rate, and it'll give you a sense of just how high this dividend could get. So I think we've established a reliable track record of returning cash and value to shareholders, whether it's through the quarterly dividend program or through buybacks. That will continue. And what we have to look forward to are continued ramp-ups in our quarterly dividend and a share price re-rating event, both of which happen commensurate with continued ramp-ups at the Duncan mine. And then longer term, we can look forward to the prospect of Black Point coming online, adding an additional royalty stream into our portfolio, and the prospect of us adding another meaningful royalty and acquisition into our already attractive portfolio. Thank you very much.